mean, I sleep very well at night knowing somebody could come and sue me. They could take my car, they could take my house, they could take my business, they could take, everything I own, but I would be able to rise like a phoenix and start all over again because they could never touch the cash inside my personal banking system. And I've got hundreds and hundreds and hundreds and hundreds of thousands of dollars inside there that I could just start right up from scratch all over again the next day and have it all back within 2 or 3 years, more than likely.
All right, guys. Hey, welcome to another episode of the Practical Wealth Show. So today is all about IBC, the infinite banking concept. And I have my new friend, Dr. Robert Scranton. And I'm going to let him tell you more about himself, but he I guess you never not, a chiropractor, right? And discovered IBC. And so what he does, he teaches people how to use their current debts and expenses to grow their wealth outside of traditional approaches like scrimping. Can't scrimp your way to freedom, right? Saving and denying themselves lifestyle that they want. And he leverages extensive background in accounting, finance, and his experience as a former chief financial architect of a cutting-edge financial firm to offer unique and highly effective financial strategy known as the infinite banking concept. And that's what we talk about. So we're going to have a good conversation. And he's a serial entrepreneur. He's got a medical background. So we're going to talk about a lot of stuff. So I'm going to tell him, Robert, what I didn't tell him. And welcome to the Practical Wealth Show.
Yeah, well, I guess maybe a little bit of my background and how I'll try to keep this brief and cut me off if it gets too long, Curtis. But yeah, I graduated from college with an accounting and finance degree, and I worked in Chicago at the beginning of my career. I worked for a public accounting firm, preparing tax returns, doing audits. Mm-hmm. I was even a financial analyst for the Florsheim Shoe Company. If any of your listeners are old enough to remember that company.
I remember it.
They used to have 350 retail stores back at that time. I don't know if they have a single one anymore. Business Casual Fridays kind of killed that company to some degree. People were buying, high-end $300, $500 men's dress shoes, quite at the pace or clip that they, had been at one time. And then I had a chiropractic experience that changed my life. And I went back to, I've always followed stuff that I'm passionate about, and not even looking at the financial or the, right. The reward, salary wise or anything. I don't know if that's smart or foolish or what. It's just been the way I've been wired. And I was like, boy, this guy was able to help me and nobody else could help me. I'd love to go back to school and, help people the way this guy helped me. So I, became a chiropractor, built and sold 2 successful chiropractic practices.
Wow. And
while it was my chiropractic practice, I was kind of following the traditional savings, retirement trajectory that most people were, what we've all been taught, what, our friends, family, what almost all our workplaces highly incentivize us, encourage us to do, and putting money into a 401k and IRA, et cetera. And then 2008, 2009 hit, and 45% of it all went poof, goodbye, all disappeared. And I did not like that feeling. I didn't really ever like watching the stock market go up and down and how it would affect my mood and how I felt during the day and how I would interact with people. And I just hated it, period. But after that, I really hated it. And I started seeing how this affected my parents were just entering their retirement years and their friends were all retiring, and boom, that nest egg just got savagely attacked at the time when they're no longer receiving any income at all. And I started noticing my parents' friends when I would go to Lowe's, back working again. And of course, I'm sure it was a bit of embarrassment, but they always had a story like, oh, well, me, Rob, I tried that retirement stuff for a year and I just couldn't handle sitting around doing nothing. So I come back here just to give me something to do. I'm like, yeah, I don't think so, buddy.
Right.
I'm sure you got hit like everybody else, and you're back here working because you got to work to make up the deficit. And so I started looking for alternatives or other ways of managing my finances and so forth. And I stumbled across this infinite banking concept, and I was like, wow, this is unbelievable. But I really was super skeptical because I was like, hey, I've got an accounting and finance degree. I've worked in this industry. I've never heard of this. Why is that? Like, you'd think I would have come across this with all that experience and, education. So I was super skeptical. I really kind of started out as the person trying to prove it wasn't true, or that it was false, or that it was a scam. And through digging and digging, the more I dug, the more I realized, like, oh, actually, this is completely true. Everything they're saying is 100% accurate. And then I got almost indignant and really angry of, why didn't I know this with my education and experience? Because I was pretty sure, with having an accounting and finance degree and working in public accounting and working as a financial analyst, if I didn't know this stuff, I'm pretty sure most Americans didn't know this stuff either. And so I started doing the infinite banking, over the last 14 years, and then started teaching other people and helping other people, set up their infinite banking systems, for their family and so forth. And at some point I could go into even more about when I first talked to my financial advisor about starting this infinite banking system.
Funny because we'll have clients, and we both have clients that will, I talked to my wealth manager, and they I was like, fortunately, that's why I tell you, I have to read the book, because you have to keep your own counsel, right? And but what I would tell them, in your words, what is the infinite banking concept?
The infinite banking concept is the ability to custody your own money in a much more protected, safe environment, and being able to recapture, recycle, and reuse the same dollars over and over and over again, and keep them inside of your family financial system, so they don't leave your system and disappear and go to somebody else, never to be seen ever again by you or your children or your future generations. And that's the things that I like about it. When I started to realize, like, wow, yeah, these banks are kind of susceptible. And I remember the story of my great grandfather and how he'd used it wasn't called the infinite banking system at that time, but he had a whole life insurance policy that he was able to utilize to save their family farm and the farmhouse during the Depression. And part of that story was the bank in their town, went bust, went out of business. Well, that happened in 2023. You and I were talking about that before. 4 of the largest 10 banks in the United States went completely out of business in the first quarter of 2023. I don't know if anybody even remembers that at this point, but that's pretty, scary.
They sweep that under the rug. I mean, big ones is like, after about a week or two, you don't hear about any of that stuff.
No, nobody even remembers that. I mean, during the Depression, I think like 3,000 banks in the United States folded and closed their doors forever.
And no insurance companies, mutual companies, through depressions, through world wars, paid claims, people are taking loans, putting money back, and kept it moving, and so
that was where people warehoused their money back, in that era. If you talk to great grandparents, that they wanted to save money, that's where they stuffed it into whole life insurance policy. That was just kind of the known thing to do, because banks were considered very risky. It was just a temporary place to, put it, but not some place you were going to store it.
Because we have a recency bias. That's like, I always tell people, like, this is not new. It's just new to you. And it's really something old being rediscovered. Right. And then, and then we're kind of doing it on purpose. Like, we talk about, you're building money that you can collateralize, but you're doing it on purpose because of some of the riders that exist now with the current whole life policies, where you can get more capital in there. And but I like, I like the theme of our topic today, the economic value of certainty. because
Mhm.
Rob, I have a bias towards guarantees and certainty. So, you know,
Me
and
too, especially after being in the stock market so heavily in 2008,
yeah, because you
2009.
can't control it. See, people think I'm investing.
No.
You're not investing because, you know, here's because I always go back to when people say, well, what did I invest in? So let me tell you what I call investment, and let's see if we're talking about the same thing. And I take them back to Benjamin Graham. An investment is something you put your capital tool in where you have safety of principal and a reasonable opportunity to make a profit. And he says, this is, you know, Warren Buffett's mentor. If it doesn't fit this definition, you are speculating, right? So most people
Mhm.
are speculating. And we're in, you know, we teach, Robin, investing is about becoming, right? And if you look like the millionaire next door, none of them credit their wealth manager, their stockbroker for making money. It's all they invested in their ideas, their
Mhm.
businesses, their real estate,
And people.
and people, and
Yeah.
that's why they're rich. And so talk about the from your perspective, what is why, and you know, past the stock market stuff, but overall the value you see in working with your clients and just in general, why certainty is so important long range.
Yeah, because it's the only way that any planning can really take place. In my investment advisor, what have you, what you would call him back, when I was still doing that at the
Mhm.
firm I was working at, um, they would create all these kind of Monte Carlo casino projections.
Mhm.
And I'm like, well, wow. I mean, it looked really exciting, really cool, really sexy. Like, wow, this is
Mhm.
amazing.
Mhm.
But I don't think most people, and I don't think myself at the time, really thought about like, what's the likelihood that this is actually going to happen? Um, there's nobody on the planet would have any idea if that was actually true. I mean, it was just like
I mean,
him
they don't have a
reading me
working
a
crystal
fantasy
ball,
novel,
right? They don't have a working crystal ball, I guess,
right?
right?
Well, I think of it as like, I've always loved reading biographies and history, um, sort of nonfiction type of stuff.
Mhm. Mhm.
And I didn't realize that I had that bias for quite a while when it came to my finances as well. I prefer nonfiction.
Mhm. Right. Right. Exactly.
As opposed to fantasy stories. And the first time I had a client when I was doing this infinite banking concept, and they came to me and say, Rob, well, I love everything that I'm learning about the infinite banking, but I really want to know for certain at a certain age that I can retire and I'll have X amount to pull out. Like that was his biggest dragon he wanted to slay,
Right.
if you will. And so I was able to go to the people putting the illustrations together at this particular life insurance company and say, okay, hey, this guy, he's 35 years old. He wants to work for 30 years, wants to retire at 65, figures he'll die according to the actuarial tables.
Mhm.
And so he wants to be able to pull $100,000 to fund his lifestyle over the 20 years from 65 to 85.
Mhm.
Um, what would that look like? And can you show what amounts need to go in and him pulling that out and us be certain that he would not run out of money? And they were able to just plug that in. It's just math. But I was able to show him because most people I think are saving, investing. They know they need to do that, but
Right.
to me, it's almost like a works-based religion. Like people are constantly doing stuff. They'll never know if they'll truly have salvation until the day they expire or die. So they're
Right.
constantly working, always in doubt, always living in uncertainty, never knowing if they're doing enough. And I think that's the same way with people when they're saving for retirement, and they're putting in, but they never know because they don't know what the market's going to do.
Right.
And what people are saying is the right amount today. In 10 years, they're saying it's a different amount. They keep moving the target. But with this, we were able to go in and just plug numbers into a table because this whole thing is done in a contract with a life insurance company. So we could tell them, okay, if you're 35, you put in this amount for the next 30 years, and you'll be able to know for certain you'll have
Mhm.
this amount to pull out at X time for X number of years. And he's like, okay, good. I'm good to go. I will work my tail off and make sure that I can put that amount away every single year because I know that it's going to turn out this way. And I think, really helps people be a lot more focused in their savings and their goals for retirement because they know that if they do X, that Y will result in that.
Worst case, right?
Yeah,
Worst case. That,
it could be
not
better.
counting taking loans and buying other assets or buying real estate. Just if I do this, I get that because it's a contract
at a bare minimum.
At a bare minimum. And I think that
Yep.
if you start with certainty, then you can build from that, and I think most people are starting with uncertainty, with fluctuating monetary units called dollars and a fluctuating stock market and wondering why they have inaccurate results.
Well, it's a logic. I mean, it's a logical incongruency or infallibility. I'm not sure what the word would be for sure to use uncertain numbers and figures today to try to predict certain numbers in the future. That's completely illogical. Like it's impossible, actually.
Let's talk about. I'm going to throw some rapid fire questions out at you because I want us to get these out there because these are the stuff that we hear. So we were talking about this before, the stuff that we both hear out there in the marketplace. First of all, let's talk about. So we talk about being your own banker. How do conventional banks actually work? And then maybe, why we want to incorporate that business model into your life. Can you speak to that?
Yeah. So, people don't realize the reason that so many banks failed in the Great Depression was because of how highly leveraged they are. They tried to illustrate that in that book, It's a Wonderful Life, if anybody's ever watched that. And remember at the Bailey's building and loan, there was a run in the bank. There was word that they were out of money and they went there and they were going to go bankrupt because everybody wanted their money right now. And he convinced everybody to take just what they needed and not more. And was telling people like, well, Mr. Jones, your money is in Mrs. Smith's house, and Mrs. Smith, your money is in Mr. Johnson's house. And he kind of illustrated that because, when you put $10,000 on deposit with a bank, the U.S. government allows them to loan that out at a 9-to-1 ratio. In other words, they make 9 $10,000 loans to other people with your $10,000 on collateral. So what that means, if there was ever a massive bank run, the first guy in line at the bank in the morning would get his $10,000, and the next 8 people would be, flat out of luck because the money is just not there.
You've seen that, like, if they'll leave it on the news in other countries, like going to, even when there was state in Washington, had all these people lining up to get their money out.
Yeah, I mean, and there's recent history of this. I remember, what was it, 2016 in Cyprus?
Yes.
They, people and tourists go to the ATM and they couldn't withdraw their money. I mean, the banks, the national bank was insolvent. The government had to come in and save it, but people literally couldn't get any money out of an ATM machine. How scary would that be?
That was scary. Yeah, and so I always think like. To me, financial planning is more about provisioning and preparing for worst case scenarios, right? And then building a foundation, like we're talking about, on certainty using the policies. But it's investing in your ideas and what you understand, but making sure, because markets go up, down, and sideways, and you have to be able to win in either one. And so that's more about you becoming thinking from a macro standpoint, as Kim Butler used to say, from a macroeconomic standpoint. And what did Nelson used to say? I know this came from the EVA article, but if you know what's going on, you'll know what to do. And most people don't know what's going on, so they don't know.
That's right. Yeah, that's burying your head in the sand is the maybe most common affliction in the United States and probably around the world.
So in your mind, bank. Well, I shouldn't put words in your mouth. That's not a good interview. Why is a bank a risky place to store wealth?
Well, first of all, you're earning almost next to no interest in there. And the interest you do earn is going to be taxed.
Yep.
And I mean, it's subject to all sorts of risk from outside forces, especially the more money you make, the bigger target you become. And all that money in your savings account, your checking account is subject to liens and judgments and IRS decisions and lawsuits of all sorts. It's considered part of your wealth and can be taken away at any time. When we custody our money, we always talk about, warehousing your money. We all warehouse or store our money somewhere. And are you going to put it in a place like that where it has all those, potential opportunities for attack from the outside? Or are you going to warehouse it and store it someplace where it has a lot more protection? Because when we have our cash stuffed into our banking policies, the cash inside there legally is considered part of the death benefit of the policy. So in almost every state, it is not subject to, liens, judgments, IRS decisions, lawsuits of any kind. And so I always sleep really well at night. And I had a mentor of mine pointed this out to me a number of years ago. And he said that he slept really well at night, knowing that, hey, even if somebody were to sue me, even falsely, illegitimately, what have you, you never have any idea what a jury might do or some crazy judge. The legal system is not fair and just. It's just the legal system. And he told me I sleep very well at night knowing somebody could come and sue me. They could take my car. They could take my house. They could take my business. They could take everything I own, but I would be able to rise like a phoenix and start all over again because they could never touch the cash inside my personal banking system. And I've got hundreds and hundreds and hundreds and hundreds of thousands of dollars inside there that I could just start right up from scratch all over again the next day and have it all back within 2 or 3 years, more than likely.
Peace of mind, because you know how to do it and you got access to capital is the key. Most people, I find, Rob, and we're working with them, is the number one problem I see is lack of access to capital because they don't save. They don't, because they're trained by Wall Street to invest, to put money at risk and give up control. And you and I are both trying to teach people to pay yourself first. And the best place to store your liquidity is properly structured dividend paying whole life. Right. So,
and isn't it interesting though, when you ask people, do you pay yourself first? Almost everybody says yes, but then you really dig into it and you can make them realize that, oh, you actually don't pay yourself first, because when you get your check from your work or your place of business, it goes straight into Wells Fargo. So they get your money. So they get paid first and they get to earn interest on your money, immediately.
And also, I know you like talking about the misconceptions with retirement accounts, because the other place they pay themselves first, or they think they're paying themselves first, they think they're saving, because they'll say like 401k retirement savings plan. Right. And I always say it's not savings, because savings shouldn't have any risk. But what are the misconceptions? Right.
Well, it shouldn't have any risk. You're right. Like from the stock market fluctuation, first of all, but plus the fact that you're sticking money away that you're not supposed to touch, or they even, will penalize you, or people won't take it out because there's taxes. The tax is always going to be there. That's kind of a silly notion that they won't use their money because they'll have to pay tax. You're going to have to pay tax eventually anyways, or somebody's going to have to pay tax on that money. But it's also the penalties. So you're right. They lock it away. They give up control, and they might have a lot of things they could do right now that would advance their financial life significantly if they were able to access and utilize that money right now, as opposed to, some time or some point, down the road in the future.
Because the industry teaches them you don't have the time, the temperament, or the training to personally manage your own money. And so all their marketing, in so many words, says basically give your money to us. Right. And
I'm with the government and I'm here to help.
Yeah, I'm here to help. It's like, okay, thanks for nothing. And I'm gonna fire some questions at you. So how much, Rob, don't I already have to be wealthy to start being my bank? How much do I need to start this? Do you get those questions?
Depending on your age, a 20-year-old probably can get started for, a couple $100 a month. So, $50 a week out of their paycheck, or whatever that would be, $10 a day. I
Yeah.
always tell people, hey, start where you're at so you can get where you want. I mean, I started, my first policy with a relatively small amount, but I was young, I was new in my career, I didn't make a whole lot of money, but I really wanted to start, my own banking system, and I'd seen how the traditional model of financial planning had significantly hampered my long-term goals and
Right.
kind of hurt me, and I saw how it affected my mindset, around money, and just it created a lot of continual fear in me that I just didn't want to live with for the rest of my life.
Answer this question. Well, am I too old to do this?
Well, I always tell people not really for the banking aspects, because think about if I were to give a $20 bill to a 20-year-old, a 40-year-old, and a 60-year-old, and I had them go to the grocery store, which one of them is going to be able to buy more groceries?
It's the same.
It's the same. So the only real difference is that the 20-year-old, when they get to the point where they're ready to graduate off of this planet, they're likely going to have a lot more death benefit because there's been a lot more years for that death benefit to grow. But if you're just looking at year-to-year comparison, it's going to be very similar from the banking aspect of how they're able to utilize it and the cash growth, accumulation, and compounding and so forth that happens inside there. Probably a bigger factor or as big a factor as age is health.
Right. That's the key. And people they'll delay, and they're not realizing that, insurability is not guaranteed. Like it is insurance. You need to get insurance, and you want to get it today, not tomorrow, because you never know. You come up and all of a sudden your A1C is 11 and you're diabetic and you can't get it.
Yeah.
Or you're rated, and
I've been running 6 and you're not taking care of your health in 6 months, it's an 8, and you're not insurable.
Yeah. And that's a thing. So these are for my practice, I call it the practice company. Isn't it just smarter to buy term and invest the difference? This is what you'll hear from I told your cousins in Primerica guys and or Uncle Dave. And
well, of course you hear that all the time. I hear that all the time. And it is, if you just look at year one and the cost comparison of the death benefit. But I always remind people, we're not, putting these banking policies in place necessarily for the banking policy. That's just kind of the cherry on top, this extra
for the death
thing.
Benefit, you mean?
With the death benefit. And, if you don't have enough of a policy yet, you might want to buy short term. But the thing about term, life insurance is it's meant for people to pay premiums for decades and never pay out, because once you reach an age where you're likely to, die or graduate off this planet, as I like to say, the premiums jack way up, go so high, most people will drop it and not want it anymore. And then they don't have any coverage. And yes, while the premiums might be less expensive the first few years in a term compared to a whole life, whole life over time, remember, it's called whole life insurance, permanent insurance. So it's meant to be permanent. It's meant to last your whole life. And if you plan for it that way, in the end, after about 10 years, permanent life insurance becomes much cheaper than term insurance, because you've gotten pretty much the way you and I designed these infinite banking policies, Curtis. You have gotten every dollar back in premium in the form of cash value that you paid in. And at that point going forward, it's essentially a free life insurance policy. And the death benefit keeps going up, over time. And by the time people get in an age when they're likely to exit this planet, they'll often have more death benefit than they or their heirs could ever even imagine is even possible, where a term is set and it will never, ever get any higher than what it was set when the policy was, first initially put into place.
Yeah. Term is, and there's nothing wrong with term, right? Because you need all our clients have term, because one of the things I always solve for also is a principle of maximum protection, right? So if you're 40, 45, I'm going to take your annual income, I'm going to multiply it by 20. That's how much insurance you're going to get, or I'm going to show you because I want to make sure. I mean, you know, I've paid over a dozen death claims, so people do die with this stuff, and I want to make sure your family has a tax-free check with some commas in it, you know, and right. And
yeah, I mean, that's every whether people know it or not, every head has a price on it, right? As far as the insurance company, they, you know, that full human life value and what they're willing to protect, and you might as well maximize it.
You might as well maximize
absolutely.
it. And you know, and so we solve for human life value, and a lot of people, so they value your life more than you do. And and so we try to, you know, implement that. So that, and also, like, I had a client call me this morning before we started recording, because I had profits. I got 50,000. You know, his policy won't hold it, but guess what? We've got some term. So we're going to do a conversion. Let's do that. I'm going to just make sure that I say, look, this is not a win. If it's just a windfall, okay, we're going to do it, but I need to make sure you can continue this going forward. This is not like a one-off, you know, this has got to be, which he will be, because I know his business is doing well, but you know, you have to do some, see, a lot of times people, I don't know if you find this, they get people, agents, that think this is a gimmick to sell life insurance. Oh, I do that. I can do that. You know,
Oh, yeah.
And I tell people, look, if the people don't, unless they hit you in the head with the book, they don't do it. Right? If they mention IUL, they don't do it. Okay.
Right.
All right. Well, since I done brought it up, let's go there for a second.
So that's definitely some good criteria. It's kind of like, how do you know? It's like that little bit of advice you give somebody. How do you know if you picked a good chiropractor? Well, if you're fully clothed and he's not, then you know you picked the wrong chiropractor.
Okay.
Or the wrong doctor. Either one.
That's funny.
Give people some criteria, whether they've picked an IBC practitioner or not.
Yeah, I mean, you know, because it's not a, see, here's the thing. So when we're talking before we start recording, it's not a product. IBC is not a product. It's a process. So I think we talked about it, but tell them your perspective on when we say that, what does that mean to you, and how do you share that with people?
Yeah, I mean, if we could use this banking process with paper clips or a desk, you know, we would use that to use these banking aspects to, you know, store, you know, our own money, to custody our own money, to have control of our own money, to put it into a tax-free environment, to have it grow and accumulate and compound with uninterrupted compounding. That's another thing we haven't even talked about, Curtis, but I don't think most people have any idea that when you have those dollars, you know, inside Wells Fargo and you're earning 0.06% interest and you have to pay tax on it. Well, as soon as you pull that, you know, say $100,000 out of your savings account, you're no longer earning any interest, you know, even as low as it is in Wells Fargo. But when you pull it out of these banking policies that we're setting up for people, you still continue to earn. All the cash accumulation happens. All the compounding never stops. It's never interrupted. Even while you have that money out doing something else, paying for your child's education, helping them make a down payment on their first house, buying a car for yourself, and you know, getting all the money back for the, you know, the car, or investing in a piece of real estate that, you know, a friend of yours is flipping and they're willing to give you a 6% to borrow the money for 30 days. So you're essentially able to earn, you know, a rate in two places at the same time with the same dollar. And that just doesn't exist with any other financial instrument that has those kind of features and benefits. That I just don't believe there's anything else on the planet that has that. If there is, you know, please let me know on this podcast, because I haven't found it, and I've been looking for about the past 14 years.
Right. Yeah, I mean, it's like hold on one second. Sorry. My phone was going off in the background, guys. So sorry. Maybe lost my train of thought. So that's good stuff. There was another question. A follow-up question I was going to answer that, and my mind just left. It just distracted me.
It's the iPhone.
Okay, it'll come back to me. So I want to talk about. Tell them some of your what gets you excited about it. Some of your experiences, or some of the you know, cool things that you've done with your policy or your clients have done that excites you to get up and go to the office every morning?
Well, just really seeing how, as I started learning this, I don't know that I really realized the whole history of whole life insurance in my family. Even when I started doing this and getting excited about it and telling my dad, that's when he started pulling out these old insurance policies. He pulled out one he took out on me when I was 1 year old.
Wow.
And I was about 30 at the time. He showed me this. He says, well, it's probably, since you're doing this anyways, it's probably time for you to take over this policy. Now, it was a $50 a year annual policy premium. But he showed me in the statement how that $50 annual premium, small numbers again, but the principle is still there. And he showed me the cash value growth of $350 for that $50 premium.
Wow.
And that's a 700% return on the dollars I was putting into there in policy premium deposits, Curtis. I mean, that's incredible. Think about that. And it's guaranteed. It's only going to get better. It's never going to go down. And then my dad pulled out a policy of his. And this is, I don't know if you've seen one this old in your career so far, but it was written in 1951. It's still in force.
Wow.
And it was a $46 annual premium policy, a $10,000 death benefit. The death benefit, or $8,000 death benefit. The death benefit now is over $32,000. So it's 4 times the original face amount. And this wasn't even set up for the infinite banking concept back at that time. But the cash value increase is about $670 per year.
Wow.
That's a 1,300% return on the dollars he's putting inside there. So I said, oh, wow, that's really interesting. So I've got a copy of that. And my dad would always say, he says, if people have trouble understanding this, he said, that's all you should need to do is show them that 70-year-old policy and how this works over time. And he said, they shouldn't even have any more questions after you show them that, because that's pretty rare to have one in force like that to show somebody. And we know how this will work over time. Look, this was written in 1941. Or 1951, sorry. And then we go even further back to my great-grandfather. And I told you about, he was a farmer. And every year in the spring, they would, go to the bank and, borrow money to buy the seed and plant their crop, harvest it, sell the crop, and then pay the bank back. Well, the bank in their town, poof, disappeared, went completely out of business. And he didn't have relationships with no people in other towns further away that would loan him money because they didn't know him. People didn't travel very far back in the 20s and 30s outside their area, and the seed company wouldn't loan him seed on credit because they're like, we're not giving credit to anybody. Everybody's going bankrupt left and right. We're not putting ourselves at that risk. If you ain't got the cash, it's cash on the barrel, or we ain't giving you any seed corn. It's like, well, what am I going to do? I can't plant a crop without seed. Right. And I remember that he had this whole life insurance policy. He contacted the company, and they said he had enough cash value in there and they could send him a check. And it was enough that he could buy the seed corn, plant his crop, sold the crop, and then paid back the cash into the whole life insurance policy. And he was totally fine through the Depression because people still had to eat, thank goodness. As long as he had access to some capital, like you said, sometimes it's that lack of capital that gets people in a lot of trouble. And so he was using this concept, back in the early 1930s. And I just thought that was a really cool, amazing,
is awesome. Yeah, that's
infinite banking story.
Yeah. This is, like I said,
my own family.
Because even the old whole life policies, they still work if you have them long enough. There's still there's nothing better to store capital long range. And so we'll get these people, they don't understand insurance, right? And we want a 90-10 split, or they want all these fancy things because they don't want the death benefit. But Jason Lowe say cash follows the leader, right? Because you're the cash value is the net present value of the death benefit at age 121 or older policy age 100. So if you've got a death benefit, the cash value will equal that at the end of the term. So you want a lot of insurance because that's got to meet each other. And so you can't, that goes back to Nelson's rule. Don't be afraid to capitalize.
Mm-hmm.
Think long range. don't steal, like your grandfather didn't steal the peas. He paid the loan back, right? So he could turn around and use it again.
Right.
And
Yep.
those are just like fundamentals, that's what I call like football. It's like block and tackling. Like, and so we don't learn how to block and tackle. We want to do flea flickers and trick plays. And
yeah. And ironically, those plays won't work either if you're not blocking.
right, exactly.
Or they will burn you if you don't know how to tackle.
So Rob, listen, as we wind down, I want you to tell them a little about how you're working with people. How can they follow you if they're interested? I love talking shop with other practitioners.
Yeah.
I think this has been a really good interview for my listeners for sure. So,
well, yeah, thanks for that, Curtis. One of the best ways to really illustrate this, I've found with a lot of people I've worked with, is something really practical. When I talk to them, I'll ask, potential clients like, hey, how many of the cars, how much money have you ever gotten back for any of the cars that you've ever bought, driven, or owned over the course of your life? Always ask a question you know the answer to. And they're like, oh, well, none. Well, how would you like to learn how to get all the money back for all the cars that you buy, drive, and own for the rest of your life?
Yes.
Yeah, I would. So I have a free masterclass where we kind of go through and outline exactly how to do that. And that's just one idea. I mean, you could apply this principle to, how to get all the money back for all the taxes that you pay to the federal government every year, or how to get all the money back for all the charitable giving to your church every year. But I have a free master class. Doesn't cost you anything. I just have to enter your information, get access to it on our website at yourfinancialiq.org. And I would encourage your listeners, that's a great place to get connected with us and to follow what we're up to. And like I said, if they want to watch that master class, I believe we've done it very well. It's very easy to follow. That at least is the feedback that I've gotten from people. If they want to learn how it is actually possible to get all the money back for all the cars you're going to buy, drive, and own the rest of your life, please watch that masterclass. I've got 3 cars in my garage. I've got all the money back for all the cars, and I've still got the cars sitting in my garage right outside at the moment. So
there you go.
It's possible, but it is mind-blowing to think about that, because nobody's ever typically heard of that before.
And just because you haven't heard of it doesn't mean it's not true. That just means it doesn't mean it's too good to be true. It means you need to investigate some more.
That's right. Yeah, like I did, right? I was the zealot trying to prove it wasn't true, that it was false, it was a scam. And what it ended up doing is turning me into a zealot, telling people about this and why they should be doing it, and how I've been using it, and how my family's been using it for generations. Obviously, as
you're like me, you went from Saul to Paul.
That's absolutely 100% accurate. Yeah. Yes. Like, this is too good to be true. I'm like, oh my gosh, this is true. And why didn't I know about this? And everybody else should know about this.
Yeah. So, yeah. And that's how you get it. You get it. And so that's how you get into it. It's like, okay, wait, I have clients that now want to work with me because like, why doesn't everybody know this? And so they're forcing me to, okay, I'm gonna have to expand the agency because I got all these people asking, can I come learn how to do this? So
that's awesome.
Which is
to become the mentor with some more teachers underneath.
Yeah, it's one of the things I like, this kind of cross interview, because I want y'all to hear that there's other people doing this, so you're not crazy. Like, we both are not like lone
not on an island,
right?
Right. Might be a voice in the wilderness, but if you listen closely enough, you hear other voices.
Yes, other voices. A lot of other good voices out there. So now you gotta. There's some charlatans out there too. So we you gotta be able to sort those out. And there's a lot on the TikToks and the whatever. But I think that if you read the book, you start with the source. Read the book.
Page 39 has become my favorite go-to with all these people wanting to claim that they can do the infinite banking concept with IULs. And just read page 39 in R. Nelson Nash's book, Becoming Your Own Banker. And he'll explain to you all about E.F. Hutton. What's interesting to me about that, and I'll I'll be quiet after this, but it just blew my mind that I remember those commercials on TV, you know, when
Me
E.F.
too.
Hutton talks and everybody would
Everybody
freeze the
listens,
screen.
right?
E.F., you know, people listen, but, you know, he even explains his book. Well, it's interesting because ain't nobody listening anymore because they're out of business and they're the ones that invented the IUL. So if IUL was so awesome, why is the company that invented it no longer exists anymore? To me, that was about all I needed to know about IULs.
Right. Actually, they invented UL, but then they keep, you
Yeah,
know,
that's the
but
next
it's all the
iterations of
same
it.
thing. It's just like
Yeah, it's
there's
right.
UL, there's VUL, that was hot when the stock market was, and there's IUL.
Yeah.
So, but they all,
What's the VUL? Doesn't that stand for very ugly life insurance?
yeah, something like that. So but the problem is they all are built on a chassis of term insurance, and term insurance gets more expensive every year.
Mm-hmm.
And
it's almost like rebuying a term insurance policy every single year. So
your cost
the
of
cost just goes up every single year.
Goes up every year, where the whole life becomes more efficient the longer you have it. And so that's why, again, we'll start with the theme of the show is there's an economic value of certainty where you know that you're building your house on rock and not sand.
Yeah, I like that name. Is that what you're going to name the episode?
I think
sounds
so.
Good.
Yeah. It just came back to me. So yes,
that's right. Okay.
So, all right, guys. Say, listen. Thanks for listening to listening to us nerd out about IBC, which was a lot of fun. Rob, thanks for
it sure was, Curtis,
coming on. We'll put your stuff in the show notes, and guys. So I hope you know. I want to hear y'all hear it from somebody other than me. So okay, that's good at this, and just kind of get this stuff out there and keep this conversation, folks. We've got to save the country, okay, and build a solid foundation and put people on good, sound economic principles. And Rob and I are doing it one family at a time, okay. And so, Rob, I thank you for your time this morning, and it was a lot of fun. Thanks for coming on the Practical Wealth Show.
Yeah, thanks for having me, Curtis. It was a lot of fun. I enjoyed it. Appreciate you.
All right, guys, go out there, make it a profitable day, and we will talk to you soon.